Let's start with where the market is at the moment. 75 basis points of cuts in the UK for next year, 100 basis points of cuts here in the United States of America. We'll get to Europe in a moment. What I want to understand is the market is baying for cuts. Is that a personification of soft landing, 75 in the UK and 100 basis points in the United States, or something more malevolent? Good morning.
Good morning, Manus, and thank you very much for having me on today. No, I think the stock market is essentially a hope machine. I think they would love to have a soft landing. I do think that the risk in the U.S. is actually to the upside of a rate increase. The data, has a little bit of cognitive dissonance. You have some data that's saying, we're going to have a soft landing, and some data that's saying there is a risk that there's going to be a rate rise. I don't think there's that risk at all. We'll get to that maybe in a bit here in the ECB or the UK. But I do think that's where the risk is, the potential rate increase. I think it's a mistake if the Fed does do that. We see it very granularly at the bank level. The senior loan officer data is telling you that credit constriction has been very, very, very severe. So I don't think they need to raise rates, but that's where your risk would be from an outsized basis.
So if the stock market right now is a hope machine, game it out for me. What happens when hope meets reality?
Well, I think what will happen is what we're seeing it happen over the last couple of weeks, right? Or last week, you've seen the stock market bid up on the expectation, that we're going to have 100 basis points next year, beginning sometime second quarter, June or so. I think what you'll hear from Powell today, Jay Powell, is going to be something more restrictive in terms of higher for longer. And I think they will be higher for longer. And so I do think there'll be a little bit of volatility. We just went through earnings season. Low volatility happens after that. But after today and after December meeting, I think you could expect some real volatility. And there is risk to the downside.
Waller said that we've had an earthquake, the 100 basis point move in the bond market. I mean, we've had multiple earthquakes, respectfully. We've gone from 0% to 500 basis points in just over a year. I mean, I call that more than an earthquake. And yet, it's only now that the slews is beginning to show a little bit of fragility. I mean, there's what Waller says. Since the end of July, this has gone one way, almost a full percentage point in central bank terms to financial markets. It's an earthquake. But that earthquake has not had the spillover that we all thought. The central bank is banking on that tightening of yields. Does Powell need to re-grasp the narrative over the next couple of days about his intention to keep things tight?
I think he will. That's what I was just saying a moment ago, Manus. I really do think that the jawboning, which is part of the Fed toolkit, we're going to be higher for longer. We're still going to evaluate the need to raise rates. And I think by doing that, they're basically helping themselves by having the long end, the 10-year go higher in terms of yields. And that's doing some of the Fed's work for it, so it doesn't actually have to raise rates. Although, again, like I said, I think there is a risk that they might do that. The market a few weeks ago had it at 25%. Now it's at 10%. But I do think there's a risk, and I think that's why you're seeing futures today some trepidation a bit, from the market.
So, Neal, you're a Virginia guy. I'm a Virginia girl. Overnight, we learned that Virginia Dems swept both state chambers. I mean, it just kind of shows us this propensity, even with Biden's bad polling, for American politics to surprise us. And we're going to get a lot of that next year. How do you want to gear up a portfolio to prepare for the volatility that is an election year in America?
Well, I think Virginia is very telling, as you know, being a Virginian, that it's a purple state. Red being Republican, blue Democrat, so purple by definition is kind of a telltale swing state. I think these elections with a very popular governor going Democrat is very telling. And so in terms of your portfolio, what I would tell you is I think it bodes poorly for the GOP in the coming elections, even with Biden's inherent weaknesses. And so I think the rollback of the 2022 Inflation Reduction Act, again, poor name, but very strong piece of legislation to support the renewables market. I think that the rollback of that and some concerns you've seen about that will not happen. The other thing people don't realize about the Inflation Reduction Act is that the renewable businesses, a lot of those, that manufacturing of pulling jobs back to America, guess where it happens? It happens in the Midwest. Ohio, Michigan, Wisconsin, Pennsylvania, that Illinois, And those are basically the swing states. And so are Republicans really going to be pulling back the Inflation Reduction Act when all those jobs are going to be kind of coming on shore with the government support? Probably not.
Yeah.
Just want to finish off with 1 or 2 points on risk. You mentioned banks at the start of the conversation. The KBW is something that you focus on, and it's had a fairly tortured year. What is the risk going into 2024? There is the KBW, I think it's down. 24 banks trading at a 30-year low. How much more risk is there? I mean, we've got massive moves in the bond market. Some people say that's where the hidden risk actually lies. We're going to talk more about that later in the show. Give us your view on banks and the risk there. The big get bigger and the small get squashed?
I think that's very well put. I think, except for that, I think there is an investment thesis for the small banks. So again, you have to buy for. America's got 3 banking systems: the large money center banks. I think the Basel III endgame hurts those. I think you're hearing Jamie Dimon and others kind of pointing that out. They're going to have to increase equity capital levels. That's going to reduce their return on tangible common equity returns. That would be not the area to focus on. The regional banks are the ones that were causing the crisis issues in March. But really where to focus from an investment thesis standpoint, we're actually very bullish at this level with the banks under $100 billion in assets, the small banks, the small banks below the regional level. Why? Because some of them are trading at 50% of book. And they're baking in, very, very high losses from a historic modeling perspective, yet the experience is not showing that. And the credit their underwriting levels were incredibly strong, have been incredibly strong since the great financial crisis. So that's where we think the smart money would be, is on the equity side of the small banks.
All right, Neal, we're going to have to end it there. Thank you so much for stopping by on your trip to London. Say hi to Virginia for me. Neal Wilson there of EJF Capital.